If you're in finance, you know the feeling. You're just drowning in noise. News, data, constant chatter. It's a 24/7 flood. So the real question is, how do you find the signal in all that mess? Well, in this explainer, we're going to dive into exactly that, how you can use conditional logic to make way smarter, more structured decisions. So let's start with a core question. When the market starts to panic, what do you do? Do you react with emotion or do you have a plan? We're going to show you how to build a framework that replaces those gut reactions with a really disciplined, evidence-based approach. So where do we even begin? Well, it all starts with the most fundamental skill, learning how to interpret new information. It's all about asking the right what-if questions so you can stay ahead of the panic. First things first, you have to get this. The market is a massive, interconnected web. A company's earnings report doesn't just exist in a vacuum, right? It sends ripples through stock prices, investor sentiment, even completely different sectors. In finance, pretty much nothing happens in isolation. And this is where a tool called conditional probability comes in. It's how the pros think about all these connected events. It's not about asking, what's the chance of a recession? It's about asking, what's the chance of a recession given that inflation just hit a 10-year high? That one word, given, is the absolute key. It recognizes that new information changes the odds. Just look at the difference here. The static view on the left, it's like driving with your eyes closed. You're ignoring new information, and because of that, you're getting risk completely wrong. But the conditional view on the right, that's dynamic. It understands that events are linked, and it uses every new piece of data to sharpen its view of what's coming next. Okay, so conditional probability is the tool, but how do we build an engine around it? How do we turn this idea into a systematic process that helps us turn gut feelings into pure logic every single time new info hits our screen? I mean, think about your own day. You are constantly bombarded with earnings releases, government reports, sudden price spikes. Trying to process all of that just on intuition, it's a recipe for disaster. You need a system. And that system is called Bayes' rule. Now, don't let the name scare you off. You absolutely do not need to be a math whiz here. Just think of it as a powerful engine, an engine for updating your beliefs. It gives you a structured way to combine what you already thought with the new evidence you're actually seeing. So how does this engine actually work? Well, it's a really simple three-step process. First, you start with your initial belief. That's your prior probability. Then step 2, you get new evidence, the likelihood, like, say, a surprise inflation report. And here's the magic. The rule mathematically weighs how strong that new evidence is against what you initially believed. The result, step 3, your updated belief, a new, smarter posterior probability. And it's a cycle. That new belief just becomes your starting point for the next piece of data. And here's the bottom line. Using a process like this forces discipline. It's like a shield against your own worst biases. It stops you from overreacting to some crazy headline or from stubbornly clinging to an old idea when all the facts have clearly changed. Okay, so these concepts are super powerful, but they're still a little abstract, right? So how do we make them tangible? Let's look at how the pros turn this logic into a visual map they can use to make real-world decisions. The thing is, you can't just keep all these conditional probabilities bouncing around in your head. To really put this thinking to work, you need to lay out all the potential paths the future could take. And for that, we use a fantastic tool called a probability tree. A probability tree is basically a visual map of the future. Each branch represents a possible outcome, and it has a probability attached to it. It just brings so much clarity to complex situations and really helps you avoid making simple, logical mistakes when you're thinking multiple steps ahead. But mapping out what could happen is one thing. Investing isn't a spectator sport. At every single step of the way, you have to make active choices. So how do we add our own decisions into this map? Well, we upgrade our probability tree to a decision tree. And this is the ultimate tool because it doesn't just show what could happen. It actually incorporates the choices you can make and, most importantly, the financial payoff of every single one of those paths. So you can see here there are 3 key parts. You have decision nodes, those are your actions, buy, sell, hold. Then you have chance nodes, those are the things you can't control, like a Fed rate hike. And finally, you have terminal nodes, which show you the payoff at the end of each path. This is literally how you model the dance between your choices and pure chance. So we have all these tools in place, but why is this structured way of thinking so incredibly critical over the long term?
It all comes down to one powerful concept that ties everything together: path dependency.
To put it simply, path dependency just means that the choices you make today directly determine the opportunities you'll have tomorrow. An investment you make now might open up 3 new possibilities down the road, while a different choice might close those doors forever. History really matters.
And this quote right here, it says it all. This isn't about making one single perfect decision today. It's about building a coherent path over time. Every single decision you make actually shapes the landscape of your future options.
So, what's the big takeaway from all this? It's that this stuff isn't about predicting the future with a crystal ball. It's about building a robust, logical, and defensible strategy that can adapt to new information and, actually stand the test of time. Which leaves us with one final thought to chew on. Take a moment and really look at your own process. Every choice you make is either expanding your future options or it's limiting them. This whole framework is designed to help you see which is which. So the question is, are your decisions opening doors or are they closing them for good?